If you click on the small arrow, and then the microphone you are using, you can select. If it's same as system, you now come to select microphone arrow. So which one are you using? Come to select the second one. Steven. No. No. I can hear you on the phone, but not on the. So join with your phone. Yes, please try that one.
Christian, I think Stephen has started the webinar.
So let's wait for a few seconds. He's going to join with his phone, and he'll be able to move the he's going to move the slides.
Okay, if you can just bear with us for a few moments. We're having a few technical issues with our speaker.
Yes, hello. Good evening, everyone. Thank you for joining today's webinar brought to you by the Institute of Financial Accountants UK, the Ghana chapter. My name is Christian Nyanohini. I'm the Regional Director for the Institute of Financial Accountants Ghana, and I'm happy to host all of you today together with our speaker, Mr. Stephen Edu. My colleague Haley is also on the in the background trying to providing us with technical support. Welcome once again. It's unfortunate we are having a little technical issue with our speaker, but we are trying as much as we could to resolve the issue with the speaker and then have him join us in a few minutes. Kindly bear with us and give us a minute to resolve the issue and get back to you.
Please, can you hear me here? Hello, can you hear me?
Yes,
Yeah,
that's working.
yeah, Stephen, we can hear you. We can hear you. Thank you for accepting to join us today. Welcome to the Institute of Financial Accountants, Ghana chapter. Before our speaker is given the floor to take us through today's presentation, Mr. Stephen, you missed a couple of the introductions we did. I have my colleague providing us technical support and the background in the name of Haley. Haley is joining us from the IFA in UK. Myself, I'm the Regional Director for the Institute of Financial Accountants, Ghana. And I'm happy to receive all members and guests, visitors who are joining us for the first time. We have been organizing continuous professional development program as part of the requirements as professional accountants. And this hasn't been the first, won't be the first and last. We are hoping to continue to bring more insightful discussions, just like we are doing today. Today, we are looking at the financial reporting standards updates. You and I can bear witness that a lot of changes might have happened in the financial reporting standards that we learned in school or we learned through our professional training. And on the job, sometimes most of us are not privy to some of these technical changes that come in. So we are using today to get ourselves abreast with the important changes and updates that have taken place since we graduated, since we became professionals, to equip ourselves on the knowledge and also build ourselves from now onwards. I'm happy to introduce to you Mr. Stephen Edu. Mr. Stephen Edu is a chartered accountant. He has an MBA and he is also a PhD candidate and currently the head of internal audit with the Student Loan Trust Fund. And I'm happy to have Stephen take us through this update, and then I hope that there will be a lot of takeaways when we are done today. So as a matter of quick house cleaning, as I call it, please, if you have any question, you can type it in the chat box. We are going to read them for Stephen to answer them as time goes on. And then at the end of the session, we are going to read the questions for him. Kindly make the questions brief and straight to the point. And also, kindly bear with us in case we encounter any technical challenges along the line. Thank you very much. Stephen, welcome to IFA Ghana chapter, and we are happy to hear from you.
Okay, thank you, Christian, and thank you, Heli, for the opportunity to share. I always say that knowledge is for sharing, and I'm happy to be part of the Institute of Financial Accountants, UK. I believe that it's going to be an opportunity to share with members, opportunity to learn together, and to also share experience. So today, as Christian said, we are here to discuss financial reporting standard updates. As professionals, from time to time, we need to revisit our standards because we work with the standards. And if there are any changes in the standards, we have to know, because as part of our ethical requirements as professionals, there's supposed to be continuous professional development and continuous professional education is key. And that's the major reason why Christian and team and the Institute has been organizing the continuous professional development and education to help us to be abreast with the current trend in our profession. So I'm going to take you through a brief history of the IFRS and the IAS. Then we'll look at the due process when it comes to the issue and revision of standards. In fact, the reason why we need a standard as professionals to work with. We also look at a bit of overview of the IFRS and the IAS. In fact, why IFRS and why IAS, and some groupings of the standards. So I'll be starting with the brief history of the IFRS and the IAS. Okay, so after the Second World War, there was a need for those of us in accountancy to have a common language, to have a common way for us to prepare and present our financial statement. So somewhere in 1973, a committee known as the International Accounting Standard Committee was funded, and the committee actually, or the body actually came from 9 different countries, including the UK, Canada, and US and Australia. And this committee, that is the International Accounting Standard Committee, was actually funded to issue accounting standards. In fact, their main objective or the main task was to issue accounting standard to promote consistency in financial reporting across countries. So obviously, after the World War II, financial statement preparation was not consistent. We need one language that we can sing together, or we can speak together as a body of accountancy. So the International Accounting Standard Committee decided to develop accounting standard. And the International Accounting Standard Committee operated within 1973 and 2000. And the committee was able to issue 14 different accounting standards covering different areas of financial reporting. So between the 1973 and 2000, the standard setting committee in charge of the issue of standards and revision of standard was the International Accounting Standard Committee. So let's look at what happened actually after 2000. There was a transition from the International Accounting Standard to the International Financial Reporting Standards. So as professionals, sometimes we wonder as to the reason why we have the International Accounting Standard and the International Financial Reporting Standards. Now, we need to understand that the International Accounting Standard Committee, after 2001, or when they actually issued the standards, all the 41 standards in 2000, in 2001, there was a bit of restructuring. So the name International Accounting Standard Committee was changed to International Accounting Standard Board, which is an independent body under the IFRS Foundation. So after 2001, when the IASB took over, their responsibility was to set international financial reporting standards. So please, we need to understand that as professionals, we need to understand that the change in name of the IAS, or the International Accounting Standard, and the IFRS is as a result of the transition when the IASB took over from the International Accountants Standard Committee. They decided to change the name of the standards that they issue. So the IASB decided to issue only IFRS. So anytime you see IFRS that has been issued, whether to revise the existing IAS or to replace the existing IAS, it is the work of the IASB. So that's the major reason why we have the IAS and the IFRS. The Standard Committee, that is the International Accounting Standard Committee, was in charge when it comes to the issue of the International Accounting Standard. And the International Accounting Standard Board is in charge of the issue of the IFRS. And please, let's note that the body has been taken over by the IASB. So when we mention International Financial Reporting Standards now, we are referring to the IAS, or the International Accounting Standard, that was issued by the International Accounting Standard Committee between the 1973 and the 2000, and the existing IFRS that is being issued by the board, because the board decided to adopt the standard that was issued by the International Accounting Standard Committee, and they decided to update and replace some of the standards. Now let's look at the adoption of this standard. So clearly, after 2003, in the European countries, it became mandatory for all companies to use IFRS in the preparation of their financial statements starting from 2005. So that the International Financial Reporting Standard will have a global recognition. So this global acceleration of the adoption of the standard became the international accounting language. So you realize that a lot of countries, including Ghana, the UK, and other African countries, have also adopted the International Financial Reporting Standard. So today, over 140 jurisdictions, including the UK, the EU, countries in Africa, including Ghana, South Africa, have adopted the International Financial Reporting Standard. The only issue we have with the adoption is the US group. Even though there has been a convergence work between the US and the IASB, the US continue to use their US GAAP. Now, let's look at some due process involved when it comes to the work of the body that issued the standard. So we've learned that the body that issued the standard now is the International Accounting Standard Board. The question is, what process do they go through when it comes to the issue and the revision of the standards? So with the issue and the revision of the standards, basically they go through 5 processes in trying to issue and revise the existing standard. So what happens is that a research and agenda setting will be identified where there is a need to involve stakeholders, get stakeholders' feedback on the need to come out with existing standard or the need to review existing standard. Then after the research and the agenda has been set, the International Accounting Standard Board will come out with a discussion paper. And please, let's note that a discussion paper publication is not a mandatory process, even though it's relevant when it comes to the due process for issue and revising the existing accounting standard, but it's not a mandatory process. So what happens is that the discussion paper is issued to get the view, the comment of the problem that is at hand and possible approaches to the problem. Then after the discussion paper, exposure draft is proposed. Please, the publication of exposure draft for all stakeholders to add their input and give feedback is a mandatory process. When it comes to the issue and revision of standard, it's a mandatory process because the public, the stakeholders are going to use the standard. So it is appropriate that once you have an exposure draft, which is just like a draft of the standard, you need to invite all stakeholders, auditors, the preparers of financial statement, regulators, the accountancy profession, people in academia to come and give their feedback on the exposure draft. So after the feedback has been given, then there will be a deliberation of the feedback where the IASB reviews the comment revise the proposal, and hold public meetings. So the standard setting board, that is the IASB, will just review the comment coming from the public, the comment coming from the regulators, the investors, and those in academia. So they will just review the comment and then hold the public meetings. So when the meeting is held, the final stage is the final standard, where the IFRS or the standard will be issued. So the body would have to meet, approve, vote, approve, and a new standard will be issued and published. So if you look at the whole document, when you are reading a standard and you read a standard holistically, you realize that a lot of deliberation goes on. A lot of decisions are taken into consideration before the standards are being issued and revised. So as professionals, when we are applying the standard and we really want to know the rationale behind the application of any standard, it will be more appropriate for us to also go and get the main document about the standard. So that is the due process involved in the issue and revision of accounting standard. Now, let's look at some of the importance of having an IFRS or an IAS. So at this point, we can say just an IFRS because we have learned that the IASB has taken over. And what they are doing is the issue of the IFRS, even though the standard setting committee also performed their work in terms of the issue of the International Accounting Standard. The whole idea is that they wanted to have a global comparability where financial statement prepared in Ghana or any of the African countries can be compared to financial statement prepared in the UK or any other countries. So that is the purpose of the IFRS. So the standard that we are using in the preparation of financial statement here in Ghana may be the same, or is supposed to be the same as standards used in the UK in terms of the preparation of financial statements. So that is the global comparability. Transparency and accountability. The application of the IFRS and the IAS enhance or strengthen accountability of management of stakeholders' work. So when it comes to transparency in terms of accountability, how we're supposed to account to our stakeholders, the application of the IFRS promotes transparency. It also builds investor confidence. So it enables investors to make an informed decision when we are all adopting or we are all using the International Financial Reporting Standard. In terms of cost, it's a cost efficiency in the sense that if you have a multinational company and everybody wants to adopt a different model in the preparation of the financial statement, obviously going for the IFRS will be a cost saving mechanism in the sense that we apply one standard, one way of auditing a particular standard, and things becomes very, very easy. Multinational companies can prepare just one set of financial statements in a multiple jurisdiction. So whether you are in the UK, you are in Canada, you are in Ghana, we can prepare consolidated financial statements to cater for all our foreign subsidiaries. So just a single standard can be able to cater for multinational companies. And that is the strength of the IFRS. And that is the new language of accountancy profession now. It also enhances clearly economic growth and support. Now, let's look at the current IFRS and the current IAS. We've discussed that the International Accounting Standard Committee, before handing over to the board, issue 41 accounting standard. Some of the standard has been revised. Some of the standards too has been changed to IFRS because when the body took over, they decided to maintain some of the standard, continuously revise the standard. But anytime the IASB want to issue standard, the standard will not be called IAS. The standard will be called International Financial Reporting Standard. That is the IFRS. So what I want to do right now is to walk you through all the applicable standards that we have so that at least by the end of this CPD, you have a fair knowledge of all the accounting standards. And as professionals, we apply it. So from time to time, we need to go back, visit our standards, because I always tell my people that this is more like our Bible in our profession. We need to know the in and out of it. Now, The first one is the International Accounting Standard 1. The IAS 1 deals with the presentation of financial statements. IAS 1 is applicable from now to 2027. Christian was talking about the new changes that we are expected to know as professionals. Please, it will interest you to know that by the end of 2027 or by the end of 2026, we are not supposed to apply IAS 1 again. In place of IAS 1, we'll be using IFRS 18. So IFRS 18 will be applicable in 2027 and is coming to replace the International Accounting Standard 1. That deals with presentation of companies' financial statements. The principles that we use in the presentation of entities' financial statement, how income statements is supposed to be prepared, how the statement of financial position is supposed to be prepared, the consolidated cash, the cash flows that we prepare as accountants, the notes that are supposed to be attached to the financial statement. Everything is in the IAS 1. The International Accounting Standard 1 deals with the preparation of entities' financial statement. The concepts that we use in the preparation of any entity's financial statement. But after 2027, IFRS 18 will take over. Even though we are waiting for 2027, the developers of the standard also advise that companies can go for early adoption. So if you go for early adoption, means that you'll not be applying IAS 1 again. But as professionals in the field, as accountants, we're supposed to know that IAS 1 will no longer be applicable starting 2027. The second accounting standard has to do with inventories. And if you look at the IAS 2, that is inventories, the key thing in this particular standard is how inventories are supposed to be measured. So as professionals, we're supposed to know that when it comes to measurement of inventories, measurement of our stocks, inventories are supposed to be measured at the lower of cost and the net realizable value. So what we need to do is that we will have to determine the cost of our inventory. We'll have to determine our net selling value of the inventory. And the standard is saying that just choose the lower of the two as the value of your inventory. That is a key thing in the standard. IAS 2 is still applicable. And if you look at the dates, that you realize that for IAS 1, I've added asterisk to the year, that 2007. It means that it has been revised. And the current or the most current revision was done somewhere 2007, but it's still applicable now. IAS 2, the current version that we are using now is the 2005. For IAS 7, it has not been revised. The statement of cash flows. So under IAS 7, it deals with the principles behind the preparation of cash flow statement, where we would have to group our activities under 3 headings, where we have the operating activities dealing mainly with items in our income statement, the sale of goods, the interest, the royalties, and the rest. The cash flow element in it. We also have the investing activities dealing with acquisition of property, plant, and equipment, and the proceeds from the disposal of our property, plant, and equipment, and the investing activities. So with the investing activities, it has to do with our equities, our liabilities, equities and liabilities. But under cash flow statement, the whole idea is that in the preparation of the statement, you need to determine only cash movement. The basis that we use in the preparation of the cash flow statement is the cash basis. So whether you are using the direct method or whether you are using the indirect method in the preparation of your cash flow statement, you should know that the basis that we have to use when it comes to the preparation of the cash flow statement would have to be the cash basis. International Accounting Standard 8 has to do with accounting policies, changes in accounting estimates and errors. How companies formulate accounting policies. Note that per the standard, once you adopt a particular policy, you would have to apply it consistently. And anytime you are selecting your policies as professionals, anytime you are selecting your policies as accountants, we're supposed to know that with the selection of our policies, we need to make reference to the standard. We need to make reference to the conceptual framework. We need to make reference to some accounting literature. So if the item is not clearly stated in the standard, then you are permitted to use your judgment. But in applying your judgment, find out how is other standard setting bodies applying that particular issue. Find out whether the standard can also be applicable in certain events. Find out the position of accounting literature. Find out what we have in the conceptual framework when it comes to application, when it comes to selection of your policies. So the standard says that once you select your policy, note that you don't change it. You can only change it when it is required by standard or its interpretation. And once you change your policy, it would have to take a retrospective application. Changes in policy does not require a prospective application. You apply it as if the change has already been in existence. That is the retrospective application. But when it comes to estimate, you are just making an assumption or trying to adjust the carrying amount of an asset or your liabilities. That is trying to estimate the useful life of an asset, trying to estimate warranty periods. And for estimates, once you have new information or once there is a new development, you are permitted by the standard to change your estimate. But when it comes to errors or mistakes, the standard says that once you identify it, correct it immediately. Once you identify it, you would have to correct it immediately. But let's note that when it comes to errors or mistakes, and it's a prior period error, if the error has occurred in the previous period and you have identified it now, find out whether the impact is material or it's not material. Materiality is a very great concept in our profession. Find out whether the misstatement is material or not. If it is material, then it's supposed to take a retrospective restatement. However, if it is not material, then it corrects it from that very year. That is the position of the standard. Now, when it comes to the IAS 10, events after reporting period, the standard is saying that after the reporting period, some events will occur. The event can be an adjusting event. It can also be a non-adjusting event. So if it is an adjusting event, it means that there was some indication at the time of reporting, just that the actual event arose after reporting. Such event requires adjustment. You would have to go back and adjust or make changes to the financial statement. So if the event has occurred after the reporting period, but before the date of authorization, before the board will meet and authorize the financial statement for issue, if any event will occur after the reporting period, but before the date of authorization, you would have to go back and make adjustment, if only it's an adjusting event. If it is a non-adjusting event, that is, if there are no indication at the time of reporting, but the actual event arose after reporting, what you have to do is that if the issue is material, then you have to disclose it in a form of notes. For income taxation under IAS 12, it has to do with the income tax element on our financial statement. How do we determine the income tax element in the financial statement? Be looking for three things: the current tax provision, whether there is under or over tax, and the deferred tax. So with the current tax, what is your taxable profit for the year? Just apply the tax rate on it. And because in most jurisdictions, taxes are paid in arrears, what you do is that you have to take it to your income statement as an expense. And that same figure goes to the statement of financial position as a current liability. Now, with the concept of deferred taxation, our activities and the application, our activities as accountants or as practitioners or preparers may be different from what the tax authorities will be doing, which may have future tax implications. Therefore, make provision for it now. That is the whole idea about the provision for deferred taxation. Determine your tax base, determine your carrying amount, find the difference, arrive at your temporary difference, apply the tax rate on the temporary difference, and you have deferred tax. For IAS 16, it has to do with property, plant, and equipment. Property, plant, and equipment. So the assets that we acquire with the assumption that we're going to use the asset for production or to render service. But those assets are supposed to last for more than one accounting year, becomes our property, plant, and equipment. So we are using it for production, we are using it for administrative purposes, and we are using it for rentals, and it's supposed to last for more than one accounting year. But please, if you have a building and you are using the building for rental gain, it does not qualify to be property, plant, and equipment. It becomes your investment property, which will be treated in line with International Accounting Standard 40. So under IAS 40, when it comes to the recognition of your asset, it's part of the asset standard. You're going to recognize it when it is probable that you're going to generate future economic benefit from the asset. You can determine the cost also reliably. You are permitted by the standard to recognize it in the company's financial statement. And after the initial recognition in terms of cost, subsequently, you can recognize the property, plant, and equipment using the cost model or using the revaluation model. But the key thing here is that if you want to use the cost model, apply it consistently. If you want to use the revaluation model, you have to also apply it consistently. So that is for IAS 16. For IAS 19, it has to do with employees' benefits. All the benefits that our employees will get becomes employee benefits. Under IAS 19, there are categories of employees' benefits. We have short-term employee benefits, we have long-term employee benefits, we have post-retirement benefits, we also have termination benefits. With the short-term employee benefit, we are referring to all the benefits employees will get that will fall within 1 year. The post-employment benefit has to do with the benefits that are supposed to be paid to employees after their active service, or benefits that are supposed to be paid to employees on their post-employment. So after the service, any post-employment benefit that you pay or retirement benefit that you pay to your employees becomes a post-retirement benefit. IAS 19 also deals with other long-term benefits, anniversary benefits, any other long-term benefits that are not post-employment benefits is also discussed in the IAS 19. And if you are terminating the appointment of your staff, you have to pay them termination benefit, and it's part of employee benefits. All the benefits are supposed to be accounted for in line with the International Accounting Standard 19. Now, for IAS 20, we're trying to do a revision of all the standards so that we can recap some of the principles. For IAS 20, it has to do with government grants and disclosure of government assistance. So once you receive a grant from the government, whether the central government, the international government, or the local government, it has to be accounted for in line with this standard. However, if you receive agriculture grant, it's supposed to be treated in line with the IAS 41 that deals with agriculture, because that very standard is for agriculture assets. So for IAS 20, once you receive a grant from the government, it's supposed to be accounted for in line with this very standard. So the standard says that if it is probable that you receive the grant and the conditions that have been attached to the grant, you comply with the conditions that have been attached to the grant, you are permitted by the standard to recognize the grant in your financial statement. And find out, are you dealing with a grant that is related to an asset? Are you dealing with a grant that is related to expenditure? So if you have been given a grant and the primary condition attached to the grant is to acquire a non-current asset, that means that is a grant related to an asset. Any other grant apart from this becomes a grant related to income. Good. For IAS 21, IAS 21 has to do with the effect of changes in foreign exchange rates. So effect of changes in foreign exchange rates. So with IAS 1, two things. Where you have a foreign operations and where you are undertaking a foreign transactions. As a company, you may undertake foreign transactions. As a company, you may also have a foreign operation. So if you're undertaking a foreign transaction and you have presentation currency, where you would have to choose the currency that you choose in the preparation and presentation of your financial statement may be different from the other functional currency. How do you do the translation? That is the whole idea under IAS 21. You are undertaking a foreign transactions. You have a foreign operation. You're supposed to prepare your financial statement in pounds. How do you do the translation? Such translations are supposed to be done in line with the International Accounting Standard 21. IAS 23 deals with borrowing costs. So once we borrow to finance the construction of a qualifying asset that will take substantial amount of time to prepare the asset for its intended use or sale. If we borrow money to finance the construction of such assets, IAS 23 is saying that the borrowing cost that you incur, that is the interest and any other cost in connection with the borrowing, must be added to the cost of the asset. It must be capitalized or added to the cost of the asset. So once you borrow money to finance the construction of a qualifying asset, the standard says that the borrowing cost would have to be capitalized or added to the assets. Any other borrowing cost must be expense. Take it to the income statement as expense. So it's a very simple standard. Once you borrow money to finance the construction of a qualifying asset, the standard says capitalize. If any other borrowing cost, expense it in the income statement. For IAS 24, it deals with related party disclosures. 3 key things. The standard is saying that if you have related parties and you have undertaken a related party transaction, just disclose it. It's a disclosure standard. Who are related parties? So we are talking about persons, an entity, who are related to the reporting entity, the entity preparing the financial statements. So whether you're a key management personnel or you are part of the group, you are a subsidiary, you are associate, you are part of the group, you are all related parties. So if you're undertaking transaction with you, it requires a disclosure. The whole idea is that if you're undertaking transaction with a related party, the transaction may not be arm's length. In case of disposals, it becomes an issue. Therefore, transactions that you undertake related parties requires a disclosure. That doesn't mean that related party transactions are bad transactions. IAS 26 deals with accounting and reporting of retirement benefit plans. So where you have a benefit scheme. So this operates like the IAS 19 employee benefits, but this is not for individual employees. Where you are dealing with a scheme, that is where you apply the International Accounting Standard 26. IAS 27 has to, IAS 27, IAS 28, 27 deals with a separate financial statement. So you have acquired a company. You have more than 50% equity investment in a particular company. That company is your investee, which is supposed to be treated in line with the IFRS 10. So please note that IAS 27, IAS 28, IFRS 3, so there are a lot of standards that works together when it comes to the preparation of the group account or the consolidated financial statement. There are multiple of standards, the IFRS 12, the IAS 11, the IAS 28, the IAS 27, IFRS 3, all deals with the preparation of consolidated financial statement. So with the 27, you need to have a separate financial statement apart from the consolidated one. The 28, if you have investment in the investee, and that is not giving you control, but it is giving you significant influence. Let's say that you are investing in a particular company, and the percentage of your investment is between 20 and 50%. If it is between 20 and 50%, you can't control. You only have an influence, and that influence is a significant influence. That investee is your associate. Therefore, you apply equity accounting in dealing with your associate, your investment at the beginning and the growth in the investment. So that is what we have under IAS 28. IAS 29 has to do with financial reporting in hyperinflationary economies. So economies that has been designated as hyperinflationary economy. At a point, the Institute of Chartered Accountants Ghana decided to conduct a research when the inflation rate, when the currency rate in the country was actually depreciating. So they conducted a research to find out whether the Ghanaian economy is now a hyperinflationary economy, where we would have to restate certain things in our financial statement. So with the hyperinflationary economies, if you have a particular, if you're operating within a particular economy and cumulatively for about 3 years, the total inflation is more than 100%, we have to classify that particular economy as a hyperinflationary economy. And when you classify it, with the preparation of the financial statement, it requires restatement in line with the IAS 29. IAS 32 has to do with financial statement presentation. Please, IAS 32, IFRS 9, IAS 39, they work together. It has to do with financial instruments. Financial instrument is just a contract where you have one party having an asset, the other party having a financial liability or equity instrument. So one party will have the asset, the other party will have the liability. So if a company issue bond and you acquire the bond, you have the financial asset. The issuer will always have the financial liabilities. How do you present your financial instrument? You present it in line with the IAS 32. IAS 33 deals with earnings per share. Earnings per share. The standard deals with two things: the determination of basic earnings per share and the determination of diluted earnings per share. So during the year, if you are issuing more shares at a full market value, how do we determine basic earnings per share? During the year, if you're undertaking the bonus issue or a right issue, bonus issue means that you want to give shares to the existing shareholders for free. Right issue means that you want to give shares to the existing shareholders at a reduced price. How do you determine the basic earnings per share? If you have a lot of convertible bonds, convertible bond is more of a poison pill in finance. It's a poison pill in the sense that at the date of maturity, the holder of the bond would have to convert or redeem. If they all decide to convert, it means that there will be dilution in terms of the earnings per share. So find out whether the conversion can lead to dilution or anti-dilution. If it will lead to dilution, then you determine your diluted earnings per share in line with IAS 33. IAS 34 deals with interim financial reporting. This is not mandatory for every company to prepare interim financial reporting, but the standard says that if you want to prepare interim financial reporting, prepare it in line with IAS 34. Interim financial reporting means the financial reporting before the annual one. So if you decide to do quarterly financial reporting, it means that you are applying interim financial reporting. If you're doing semi-annually, you are applying interim financial reporting. IAS 36 has to do with impairment of assets. If the recoverable amount of an asset is lower than its carrying value, it means that the asset has impaired. Therefore, you have to record you are not supposed to record assets more than its recoverable amount. That is the whole idea in the standard. So once the carrying amount becomes higher than the recoverable amount, we will say that the asset has impaired. Therefore, we need to bring the asset back to its recoverable amount. That is the purpose of IAS 37. So be looking for the indicators. Apart from assets like goodwill, intangible assets with indefinite useful life, which may require annual tests of impairment, with the other assets, be looking for the indicators. Once the indicators are clear, then you conduct impairment tests to find out whether the asset has impaired or not. Provisions, contingent liabilities, and contingent assets. With provisions, we are referring to your obligations with uncertain timing and uncertain amounts. So once you have a reliable estimate, once you have an obligation, whether it's a constructive obligation, whether it's a legal obligation, and it will lead to a transfer of resources to third parties, provide. Contingent liabilities. If your contingent liability is probable, just disclose it. You would have to disclose it. So apart from that, you're supposed to provide for it in line with the standard. Now let's look at the IAS 38, intangible assets. So intangible assets, assets that are not tangible, assets that does not have a physical substance. Such assets are intangible, but it will lead to a future economic benefit. You can determine the cost reliably. It becomes your intangible asset. For intangible assets, once you have an asset that will lead to a future inflow, it is identifiable. It is separable from other assets. And the asset has not been recognized in line with other assets. Just add it to your intangible assets or capitalize it as part of your intangible assets. And once you capitalize it as part of your intangible assets, you determine the cost as its initial measurement. Subsequently, you can decide to use the cost model or the revaluation model. But in using the revaluation model, it means that you should be in a position to determine the realizable amount of the intangible assets. But if you are using the cost model, you find out whether the intangible asset qualifies for amortization, then you amortize it. For IAS 39, still on financial instruments, even though the IAS 39 has been superseded by IFRS 9, but when it comes to application of hedge accounting, the standard permits the application of IAS 39. IAS 40 deals with investment property, two assets, land or building or both. And we are holding it for capital appreciation or for renters. So if you have a land or building and it's for capital appreciation or for renters, it becomes your investment property. And such assets are supposed to be recognized or treated in line with the standard. So initially you have cost. Subsequently, you can use the cost or the fair value model when it comes to the recognition of your investment property. Now, globally, we didn't have a standard that regulates agriculture. And that's the major reason why the standard setting bodies decided to issue the IAS 41 for agriculture. The purpose of IAS 41 is to cater for agricultural produce, agriculture activities, biological assets. So such assets, how do you measure it initially? How do you measure it subsequently? Those measurements are supposed to be in line with the application of IFRS, IAS 41. Now, because of time, let's move on to some of the IFRS. So with the IFRS 1, it has to do with first-time adoption of financial reporting standard. So when you are adopting financial reporting standard for the first time, please make sure the cost that you're going to incur will be lower than the benefits. So if a company is adopting IFRS for the first time, the cost should be lower than the benefits. It should be more transparent. IFRS 2 deals with share-based payments. If the company wants to use its share as the basis for payment, so once the company receives goods or services, by way of consideration, they want to use their own share, tech transactions are supposed to be treated in line with IFRS 2. If you want to settle your employees in terms of shares, when they work for the company for a number of years, share-based payment, whether you are going to use the equity settled or use the cash settled. IFRS 3 deals with business combination, which still deals with the application of the group accounting or the consolidated financial reporting. IFRS 5 deals with non-current asset held for sale and discontinued operation. So if you have a non-current asset and at the end of the reporting period, you want to sell the non-current asset, such transactions are supposed to be treated in line with IFRS 5. What it simply means is that remove it from your non-current asset, dump it in current asset, and measure it at the lower of carrying amount and fair value less cost to sell. Determine the carrying amount, determine the fair value less cost to sell, and choose the lower of the two as the new value of the held for sale asset. If you have a subsidiary that you acquire with the intention of resale, it's a discontinued operation. And such transactions are supposed to be treated, it's supposed to be disclosed in line with the IFRS 5. When you have a specialized asset, like a mining resources, such assets are supposed to be treated in line with the IFRS 6 because IFRS 6 deals with the mining industry. How we exploit, how we evaluate our mining resources. I've already talked about the financial instrument. So IFRS 5 has to do with disclosures relating to financial instruments. IFRS 9 has to do with financial instruments. IFRS 8, where you want to have a reportable segment. So instead of presenting one statement, you think that you are getting about 15%, more than 20% or 15% revenue coming from a particular segment. We want to group a particular segment based on location or other variables, where you want to have a different segments in terms of your reporting. Management are permitted to apply the IFRS 8 in terms of segmenting their reports. IFRS 10 deals with the preparation of consolidated. IFRS 11.2 has to do with joint arrangement, and for joint arrangement, you have an arrangement where it can be a joint venture, it can be a joint operation. Is it standardized or it's not standardized? If it is a joint venture, it means that your equity accounting will be coming in. If it is a joint operation, it means that you need to determine your share of the assets, the liabilities, the income. IFRS 12, disclosure of interest in other entities, also moves with the consolidation. IFRS 13 deals with fair value measurement, how we determine fair values. So fair value has been mentioned a number of times in the other standards. So the standard setting body, IASB, decided to issue a separate standard on fair value measurement, or how to determine fair value. That is the price that you're going to receive in exchange of an asset or to settle a liability in an orderly business transaction. So for fair value measurement, the attention is supposed to be on observable input than non-observable input. So when you are dealing with deferral, when you are dealing with regulatory industries like the ECGs and the rest, you apply the IFRS 14, regulatory deferral account. IFRS 15 deals with revenue from contract with customers. How do you recognize revenue from the contracts you undertake with customers? So this is a combination of two previous standards, the old IAS 18 and the old IAS 11. So before you recognize revenue, there should be a contract. There should be a performance obligation within a contract. You should be able to determine the transaction price. You recognize the revenue when you satisfy the performance obligations. Lease. So with the IFRS 16, which has come to replace the old IAS 17, the whole idea is that in the books of the lessee, instead of having operating lease or finance lease, just recognize the right of use assets. You recognize your lease obligation in the books of only the lessee, but in the books of the lessor or the right owner, your operating lease, your financial lease classification can still be done when you are dealing with IFRS 16. IFRS 17 is specific. It's on insurance contracts. So when you are dealing with insurance-related activities, when you're operating within the insurance industry, that is where you apply the IFRS 17. Please, let's note that these two standards are yet to be applicable. I've already talked about the IFRS 18, that is the presentation and disclosure in the financial statement, which was issued somewhere 2024, but it's yet to be applicable. Subsidiaries without public accountability disclosures, that is the IFRS 19, issued in 2024, but is yet to be implemented. So these are new standards, the new work that the body that we've discussed are just implementing. We also have sustainability issues. As accountants, as professionals, we need to also think about the environment, how our activities are affecting the physical environment. So the IASB has issued two sustainability standards, that is the IFRS S1 and S2, where the S1 deals with the general requirement for disclosures of sustainability-related financial information. So how you disclose sustainability-related financial information is in the S1, and the S2 deals with climate-related disclosures. And all these standards were issued in the year 2023. So these are other pronouncements, other works that have been performed by the standard board the conceptual framework, which deals with the theoretical principles that we apply in our profession. The current one is in 2018. The National Financial Reporting Standards to the IFRS for small and medium enterprise, IFRS practice statements, management commentary, IFRS practice making materiality and judgment to developed in 2017. Now, these are standards that have been withdrawn or superseded. So when we're going through the standard, you realize that some of the numbers were missing. Even with the IFRS, you realize that IFRS 4, I didn't mention it, IFRS 4 has been superseded by the IFRS 17. The IFRS 4 deals with the insurance contract and it has been superseded. We don't apply IAS 3 again. IAS 4 is no more. IAS 5 is no more. IAS 6 is no more. IAS 11, IAS 13, IAS 14, 15, 17, 18, 22, 25, 30, 35. They are no more because it has been withdrawn or it has been superseded, and I've provided the status of it, the new standard that has replaced it, and whether it has been withdrawn completely. Because when the IPSAS board took over, they decided to review the existing standard, maintain some, update or revise the existing one, and issue their own IFRS. So what I decided to do is for you to be able to capture the standards at a glance. I'm using IFRS at a glance in the sense that, per what we discussed, the IASB, which is now the standard setting body who took over somewhere 2001, issue only IFRS. So when we hear IFRS, we are talking about the IFRS itself and the old IAS that was issued by the International Accounting Standard Committee. So with this classification, what I did was to group the standards under 6 headings: presentation and general principles, that is the IAS 21, IAS 1, IFRS 8, IAS 7, 34, 8, 10, IFRS 1, 24, IFRS 18, which is yet to replace the IAS 1, and IAS 33. And the standard that relates to assets, whether it's the financial assets, whether it's the tangible assets, or whether it's intangible assets, IAS 2, IAS 40, IAS 16, IAS 41, IAS 23, IFRS 5, IAS 36, IAS 38, IFRS 5, IFRS 7, IFRS 9, IFRS 13, IAS 20, IFRS 15. Group accounts, group consolidated financial statement. All these standards relate to the preparation of the group accounts. The IFRS 3, IAS 28, IAS 27, IFRS 19, which is yet to be applicable, IFRS 10, IFRS 11, IFRS 12, all deal with group accounts. And standards dealing with liabilities and provisions: IFRS 2, IFRS 16, IAS 12, IAS 19, 20, IAS 32, IAS 26, IAS 37, IFRS, and specialized industry, IFRS 6, the mineral resources, IFRS 14, IFRS 17, and the sustainability standard as S1 and S2. So please. Okay, so generally what we have discussed within this 1 hour is to look at some history behind the application of the IAS and IFRS. It's our standards as professionals, so we need to know the history. Why the transition from IAS and IFRS, we've also looked at that. That is when the board took over from the committee. We've also have a general overview of all the IAS in existence, all the IFRS in existence. And the last slide here is to share with you some groupings that can help you to be able to understand the standards, to be able to understand what goes into the standard. So I want to thank you for your time, because I need to operate within the time that has been given. So thank you for your attention. And if there are few questions, we can take few questions.
Thank you very much.
Unfortunately, yeah, because of time, we couldn't discuss the real details.
No, I think I think we will have to come for a part 2, and where we are going to deliberate further. In fact, with IFA, we even have a diploma in IFRS. That shows how broad
Good.
issues of
Good.
IFRS could be. So these are something that we can't get all covered in a span of an hour or two. We require series. We also encourage members who, this is an eye opener. So we encourage members to also embrace the new IFA diploma in IFRS. I think, Stephen, I've been having this discussion with you for some time, and
Yeah.
it's something that very soon we are going to materialize it for members and non-members to partake in the IFA diploma in IFRS. This has been a very insightful session for me, myself, with the current updates, and there's a lot of take home. So, Stephen, we will have to bring you again for the part 2, even before
All right. All
we
right. That's
launch
fine.
our diploma in IFRS program. So let's
That's fine.
take a few questions. One question from Nat. He says, how will the new IFRS 18, that's presentation and disclosure in financial statement standard, impact our financial reporting, particularly with regards to the classification of income and expenses into operating, investing, and financing categories? Should I take the next one?
Okay, yes. So let me talk about it. So if you look
Okay.
at the new standard, that is the IFRS 18, I didn't really go into detail because of what Christian Riley said, because we're going to have a section to look at the detail. But it's just a minor changes with the normal IAS 1. But we're going to have a time to discuss the details of the IFRS 18. But please, the IFRS 18 is supposed to be applicable in 2027. So we still have a lot of time to prepare ourselves to know the in and out of the standard. So I believe, yes, with the new standards, we're going to have a section on it so that we go into detail into the standard.
Okay, thank you very much, Stephen. I hope, Nat, your question is answered. There's another one also. Okay, someone is asking if we could share the presentation. Stephen, would you like us to share the slides with
I
persons?
think it depends on the institute. If the institute
Yes,
wants to
so we
share with
normally
members.
share the slides with persons who registered for the event. Some are joining as guests. We give quite a number of days for the registration to attend, but notwithstanding, anyone who may want to have the slides can contact me via email, no WhatsApp, via email, so that we can make it available to you. So those who are asking about the slides, yes, we can make it available. If you registered, you should receive it after this session. And then the same applies to the CPD certificate. It's also going to be available to persons who registered for the event. If you did not register and you may have to show that you really actually attended the session. And if you want the slides too, you can send me an email. The Institute of Financial Accountants, it's a full member of the International Federation of Accountants, IFAC. We are one of the institutes that provide dual certification. So members of the Institute of Financial Accountants get certification also for the Institute of Public Accountants in Australia. Apart from these CPDs we are organizing for our members, there are quite interesting benefits we provide to our members in Ghana and globally. If you would want to have more information about the institute, kindly send me an email, christiano@ifa.org.uk. I will drop it in the chat for everyone. And then the same email will be used to request for the slides and any enquiries that you may want to do from this. Thank you very much, members, for joining. And thank you very much for Stephen. In fact, Stephen, we have been cooking this for more than a year now. And
Yeah, sure.
I'm happy we have been able to do this. And I'm promising attendees that we are going to have another session. And I'm hoping that by the time we have that session, we will be able to do the IFA diploma in IFRS in Ghana here. And I will be happy to have members join. Today's attendance has been very encouraging. And Stephen, I'm hoping that you are always available and when we want to reach out to you for future engagements like this. Look out for the second version of this, and thank you so much for coming. Thank you very much, Stephen. We are going to progress the conversation from here. Thank you, members.
All right.
Thank you, members. Thank you, Haley. Thank you, IFA, and everyone for joining today's session. Have a good evening. Bye.
Bye.